Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant with you, my colleagues Nigel and Surbi. Guys, good morning.
Hi. Good morning, folks. So middle of the week.
Yeah.
Kind of muddling along right now because Monday was great. Yesterday was a pause. We have lots of global news to discuss as well.
Well, that's right, Prashant. So let's get straight to the action.
The S&P is, by the way, in the black for the year.
Yes.
After being down 17% earlier this year.
I mean, it's just what, May, right? And already we've had up and down and down and up. So it's just an absolutely crazy year so far. But let's take it from the top. I mean, what really happened? As I said, the S&P 500 took out 5,900, 5,900 as a level intraday, and we ended at about 58.86. But we've now reversed all of the losses of 2025 so far. Black for the year. That's quite something. Now, the final close, S&P about 0.75% higher. NASDAQ was up about 1.6%. The inflation numbers were softer than expected. So this is the thing, right? Despite all the tariffs and all the front loading, and I mean, of course, this agreement, US-China agreement just happened now. The data does not reflect this agreement because this is past data, but it was softer than expectations. But look at the market reaction. That was not, yields were down 1 basis points after the big 12% move the day before. It's about 4.5% of the 10-year. Dollar, though, I think came off more sharply, about 0.75% lower on the dollar index, almost 101 or so by the US market close time. Oil prices, and I've been saying this, oil's kind of felt out of sync with what's happening with equities because it's largely risk on. I mean, if it is financial flows, it kind of goes into everything. And oil is another commodity, and financial flows have been going into equities, and oil's still down quite a bit. So maybe there is a bit more catch-up here in that sense. I'm not talking about fundamentals in terms of more supply in the market or anything of that sort, but keep an eye. Now, President Trump is, of course, in the Middle East, and he said he'll lift all sanctions on Syria. That is one. He also, by the way, said that the Saudis are going to invest $1 trillion. And this is, this trip largely is to kind of show deal wins and investment wins, etc. On the other side, NVIDIA is going to sort of, work with a Saudi public sector company. NVIDIA, by the way, was up about 5-6% yesterday. So more on this later. Goldman Sachs, I put this out yesterday, Goldman Sachs has upped their forecast for GDP in the US to 1%. Now they've also raised GDP forecast for China. So it's 4.6% compared to 4% earlier. This is for this year, that is 2025. And I mean, if you are somebody who follows flows and kind of, regional flows, etc. I mean, China certainly after this deal, it's getting more and more, the view is getting more and more entrenched that they've gotten a lot without giving in too much. So they've been unambiguously the clear winners, at least as far as round one is concerned, between the US and China, Trump and China, rather, I should say. Now, just to tie in the levels, Nifty yesterday, of course, gave back about 40% of Monday's big gains. The immediate support, is the 40-hourly moving average, which is 24,485. It's about 100 points out from where we left off yesterday. That should hold. I mean, if this is tactically risk-on kind of a market, hourly average on the hourly chart should not break. So I'd watch out for that. And of course, the recent highs, etc., are a reference point on the way up. Nifty Bank, the support here is the 20-day moving average, which is 54,504. Again, it's less than 1% away from where we left off yesterday. And of course, here as well, the 550 was the high that we saw yesterday. And I think you need to see a break above that. The big cut, of course, was in the Nifty stocks, not so much in the Nifty Bank. And of course, the broader markets actually, if anything, ended higher. They were actually up on the day, even on a day like yesterday. GIFT Nifty will give you a quick sense of how we are starting. It's a 90-point higher start. Surbi.
It's looking actually quite impressive because not all markets in Asia are showing this kind of enthusiasm today. The picture is getting a little more mixed because that big event has played out on Monday. The question is what happens from here on. So let's talk about, how some of the Asian markets are poised. So the Hang Seng is doing well. Taiwan's doing well. The mainland Chinese market is absolutely flat. There's some profit taking in Japan. So you're seeing a mix of green and red across the Asian screens. That's point number one. Chip stocks have been higher because of this deal that was announced in Saudi Arabia, with Nvidia looking all set to sell a lot of its powerful chips to a Saudi company. This is 18,000 GB300. These are their most powerful Blackwell chips. They are selling these to a Saudi company called Humain. And because of this large order, the stock was up about 6%. And a lot of that enthusiasm has now spread across to chip-making stocks in Asia as well. This will be used for large data centers, etc., by the Saudi company. The S&P, of course, has turned positive for the year. So the positivity and the follow-through from that US-China trade deal was still very much evident in US stocks. The question is how much of it continues in Asia. And for us, I mean, really where things stand. By the way, crude gained 3%. A lot of markets are pulling back. So crude gained 3%. That was the, that continuing reaction to the US-China trade deal. But since this morning it's cooled off, for us, it's important to note that crude has snapped back to about 66 from falling below 60 a couple of days back. So keep that in mind as well. Now for the Indian market, we've had the reaction to two mega events. This cessation of hostilities between India and Pak and the global, event, which is the US-China trade deal. The two events are over. What now? And the market is in a bit of a what now situation. Now, the what now is not being answered too positively or too emphatically by FPIs, because if you're looking for very large FPI flows coming back in, it hasn't happened yet. Could it start, in the coming days? Who knows? But let's get the flows picture. Yesterday, they were, in fact, on the sell side. Sold off cash market stocks worth about 470 odd crores. Domestic institutions were buyers, so no problems there. About 4,300 crores of buying coming in from the DII fraternity. But that FPI number, it has been a little confusing. 1 or 2 days of selling when the escalation was really on. Then 1 day of pause. Yesterday was a sell. So let's see. The FPI trend's not very clear. There is macro cheer, however, in India, and that's inflation. Guess what? CPI inflation falling to an almost 6-year low. This is the lowest print that we've seen since July of 2019, so looking very good. And the deceleration is being led by food prices, by vegetable prices, because there the fall in prices is very, very severe. Vegetable inflation is at a minus 11% versus a minus 7% month on month. So it's looking good on the CPI inflation front. Obviously, the expectations from the RBI, therefore, perhaps go up a notch. Lots of stocks and news. It's the fag end of earnings season. Some big numbers have come through. Tata Motors is actually not looking too bad. Their profit is above estimate. And more importantly, they've managed to meet the lower end of their margin guidance for JLR. But the commentary is cautious, given what's happening in the global backdrop. Bharti Airtel, again, steady numbers coming in. ARPU has, if you look at it year on year, it's a massive surge, 245. But of course, quarter on quarter, that ARPU is flat. But otherwise, the numbers are more or less ahead of estimates. And watch out for defense stocks, right? They rallied yesterday as well because the mood is still very much in their favor. The numbers have to add up as well. And for Garden, they're actually adding up. The numbers came in and they're looking very, very good. So we'll watch out for this. Leave you with today's results tally. Some interesting names today as well. There's Eicher Motors, Lupin, Shree Cement. There's HAL, Hindustan Aeronautics, and Jubilant Foods. So I think a lot of those earnings will keep us busy today. Nigel.
Well, that's right. It looks like the Nifty could see a little bit of a consolidation in the near term, but it's heartening to see that we have the broader markets that are outperforming, because that's what makes your portfolio look quite good. Let's take the top cues then. Yesterday's trading session saw the premium on the Nifty. In fact, that contracted. You were wondering whether or not there was unwinding of positions or there were shots that were getting added. I'll tell you what, there was a bit of both, because there was unwinding of positions for the Nifty as well as the Nifty Bank. If you look at the total open interest, it was low in yesterday's trading session. So that's the market on the whole. And from the FI basket, well, they added short positions. I was mentioning this a couple of trading sessions ago. You want some shots into the system, and it seems my wish at least has been granted, because you had some long unwinding in trade yesterday, and you had some shots that did get added. And now if you look at the net short positions, well, it's moved to around 35,000 contracts on from the FIs on index futures. So this is the highest that we've seen in the last 20 days or so. Even if you look at the stock futures, well, they added some shots yesterday, but that could be a bit of an arbitrage that's playing out. So there was some kind of, unwinding that we saw on the stock futures. We just get to that in a bit. The clients, what did they do? Well, the clients have been getting this correct, and they were net short on the index. Now they've done a bit of a U-turn. So they've gone net long. So this actually is a good combination for the markets to trend up. The FI is short, the clients long, because they have been getting it correct. But as I said, what do the FIs do, on stock futures? That comes up for you. Some long unwinding as well as short addition. There could be an element of arbitrage out here. Moving to the options data then. Yesterday, we had made this point that the PCR was moving towards the higher end of the range. So it had moved to around 1.3. The higher end of the range was around 1.5, 1.6. But that's cooled off. How did that happen? a lot of those puts that were written, they came in for unwinding in yesterday's trading session. And on the call side, you had a mix of activity that was seen out there. The call writers, in fact, came back into play. The 24,600 call had a good amount of open interest built up out there, premium at around 128 rupees or thereabouts. And the 24,800 call as well, there was a mix of activity that we saw out here. Which brings us to the levels. Going by the options data, going by the recent resistance level, on the way up, the 24,500 was a bit of a hurdle. So that becomes the near-term support. This is the broad range you're looking at for the day. But you'll have to say the trend is still up till the 20 DMA is protected on the Nifty. And the Nifty Bank as well, that will become the first reference point for today's trading session, which is just 1% or so away. We should get the 20 DMA up for you on the screen. Stocks that I'm looking at, well, I'm looking at Z. That's one of the biggest underperformers over the last few years. But the stock actually has perked up, and yesterday it moved on very, very high volumes as well. They say that the promoter knows what's the asset value, and the promoter holding in this company is very, very low. But it was reported on the exchanges that 2 sessions ago, the promoter entity went ahead and chipped in some shares. So I'll keep an eye out on Z because the commentary has been good, and now the promoter is sneaking in there and, in fact, buying some shares.
Okay, all right, got that. Thanks, Nigel, very much for that. So let's see whether the bulls can actually build on the momentum. Yesterday was a pause day. Will they come back or not? That's the question. Like we've been telling you, one good news that's come in is on the macro front here in India, because we're looking at CPI inflation really behaving itself. The question is whether it will continue. A lot of, the guests that we've been speaking to kind of indicate that. With the monsoons expected to be bountiful, perhaps this ugly monster of food inflation, perhaps it's, well and truly behind us. I think we'll have Lata join in just a second to talk about this. Yeah, I think we have Lata. Lata, good morning. So good news coming in on inflation.
Oh, yes. And it's important that it's repeating, month after month. At the moment, this, of course, for breaking records, 6-year low at 3.16. The last we saw it was in mid-July. And largely dragged down by food. Food is at 1.78% inflation. And that is, again, a 42-month low, which is what? 3.5-year low. And the components, cereal, vegetables are down even month on month. Cereals usually fall April over March, but vegetables start inching up because it is summer. This time we've seen vegetables fall 7% month on month. And of course, they are down a good 10-11% compared to year-ago levels. And mind you, this is food inflation is lower in spite of milk prices having been raised in April. So this is very good numbers. And I just want to point out a data detail. This is the 4th month that inflation is surprising our poll. It's from January, we have seen the numbers coming below our poll. This time the poll was 3.2. It's coming at 3.16, not much lower, but still importantly lower. Now, core inflation is another number I should mention at it's actually at 4.1. But if you take away gold and silver, then it falls to 3.4. So there are really no complaints even about the components. If you're getting a sub 4% number all through, it looks like it's going to be surprising below economists' expectations for the rest of the year as well. For instance, in April, May, June, the Reserve Bank's forecast is 3.6. Now, first month, you have got April 3.16. The current one, May, is also expected to come in at 3.16. In fact, Goldman Sachs tells us that their number is 2.9 for the current month, May. Almost all economists believe that the Reserve Bank 3.6 will not be met at all. It will be a good 40-50 basis points lower, the average for April, May, June. So what does that mean? Everyone is going to lower their full-year forecast, and many of them already have. Kotak and ICRA, for instance, have cut their full-year CPI to 3.5. Earlier number was 4%. Reserve Bank's number is also 4%. MK and HDFC Bank, other economists we spoke to, are poised to cut it to 3.7. So all this means where will the repo rate stop? Of course, a cut is there on June 6th, but there are small noises that it could be a double cut. Then there are noises that it need not be just 2 cuts. You don't have to go to 5.5. If inflation is going down to 3.5, then you normally keep 1.5% plus. So 3.5 plus 1.5, the Reserve Bank can go all the way to 5. Kotak is saying that they're expecting 4 more cuts. So the point is the market is expecting a lot of help from the Reserve Bank, not just liquidity, but also rate cuts. The US CPI has also come in slightly softer than expected. So even from the global front, there isn't much of a challenge. We should expect a dovish RBI.
Lata, thank you very much for that. Guys, by the way, when Lata talked about food prices, have you checked on mango prices? I mean,
It doesn't show. Every time I open my quick commerce apps.
1600?
no, don't go to quick commerce. I'm talking about you got to go to the market.
The real market. Okay, fine, yeah.
Which one are you talking about now? 1600 for what? Which variety?
No, I
You
just
got to be
get-
specific.
No, I get
because
the
they're all there now in the
1600,
market.
I mean-
Hapus, Safeda,
Yeah.
there's Alfonso, of course. I mean,
No, I
there's-
just-
I only
you know,
stick
so-
to people who bring gifts home. When it comes to me too, they bring. I don't try to buy.
I'm looking, ma'am, for a gift.
all right. Well, it's really a bountiful season.
Yeah.
It's a good harvest this time, and unlike the last year, actually, as far as mangoes go. Let's talk about the global stuff. Back to the global stuff. Paul Grunwald is global chief economist at S&P Global Ratings. He's with us. Paul, great to have you with us here on the program. Thank you for your time. Suddenly this cloud of global growth getting hit very severely because of US-China trade war is lifted a little bit. Have you made any estimate changes? I was looking at sell-side brokers like Goldman Sachs. They've lifted the China GDP forecast. They've lifted the US GDP forecast. We actually had the Goldman Sachs guest with us yesterday. Any changes you've made at S&P? Paul, are you there?
Sure. Yes.
Go on, please. Go on.
Yeah. So we had a forecast in March, and then we had to revise that because of the tariff escalation on U.S.-China, and we put out another one on May 1st. Now that the tariffs have mostly rolled back and we're on pause, we're probably back to that March forecast where we've got China's growth around 4% this year, and the U.S. probably still closer to 2 on an average basis. But you are correct. I think this pause and reduction in U.S.-China tariffs gives a little bit of tailwinds to growth, at least over the next 90 days. We'll have to see how that pans out.
Yeah. Got it. We'll have to see how that pans out. Just one point, Paul, if you will, and this is with regards to India, right? India was looking like it'll be the first in line to get a trade deal. Yesterday, we got news that India is gone to the WTO and proposed retaliatory tariffs on US aluminum, steel, etc. There's some chatter here, and maybe it's an unfair question to you, but that it's kind of is showing unhappiness with what the US is really doing on some of the statements which have come with regards to India, Pakistan, and the conflict here. Leave that as it may. But what is your own sense on this issue here, India and India and the US, and a trade deal and a potential trade deal?
Yeah, so we've only had 2 trade deals so far, and both of them have been provisional, right? We had one with the UK that was announced last week, and then we had the one with China over the weekend. We don't know whether those are templates for other deals, so it's hard to say what's going to happen to India. In the news reports here in New York, they are, of course, reporting that the U.S. is talking with many countries, including India. The pattern seems to be, for now, that the 10% that was announced on Liberation Day is a floor, and that so-called reciprocal tariff on top of that is up for negotiation. So again, that hasn't been declared as a template, but that seems to be the model the U.S. is using. I'm not sure China would be kind of a prototype, because that's a special, relationship with the U.S. and China. India might be with sort of another group, but remains to be seen what the actual negotiating space is. But that 10% does appear to be a floor for most of these negotiations.
Sure. Paul, on US-China, so it's a big climb down, right? From 145% to now they're at 30%. It's massive. Now, we don't know where it finally ends once this 90-day window is over. What's your best case sense? And more importantly, I think most are predicting a recession in the second half in the US right now. Do you think that can be averted? Or even if the US does go into a recession at some point this year, will it be a very shallow and fleeting one?
Yeah, let me take the second question first. We actually do not have a recession in our U.S. baseline, but we do have a very steep slowdown in growth. So let's remember the US has been growing almost 3% the last couple of years. So we came into 2025 growing almost 3%. We think that's going to end up between 0 and 1. So we have a pretty big deceleration, but it's not actually a technical recession. And again, developments over the weekend with US-China suggest the recession probability probably went down a bit. We're sitting at around 35% right now, but we'll be revising that in the coming weeks. Where US-China lands, that's really anybody's guess. I think we're all pretty confident saying that the triple-digit tariffs on both sides were not sustainable. That actually ground trade to a halt, as we know. But now we're at 10 on one side and about 30 on the other side for Chinese.
Yeah.
I think we've just lost that line with Paul.
Like 6, one really knows.
Right. Paul, just one last question. If it looks like, the US has really, in a way, blinked first, and China's kind of sort of given in very little to get these tariffs down to this, and now, of course, there'll be further negotiations, which means US, this entire thesis that, US will collect so much in tariffs that they'll be able to lower taxes for Americans, and then there'll be a boost on that front. I mean, all that on the corporate tax front, etc. Does all that look a little shaky now, Paul?
Well, to be honest, we were never really true believers in that. Tariffs look like they're going to bring in something like $8 billion per year, which is not nearly enough to cover U.S. income tax payments. And we were also a little bit that we're going to bring manufacturing back to the U.S. Our view is that there's no winners from the trade war, and the tariffs are actually a tax that's mostly paid by U.S. consumers. So we're pretty heartened to see the tariffs rolled back, and hopefully we can get them as low as possible. That's going to help growth and everything else, help central banks, etc. It's going to keep inflation lower. So we'll have to see how all of this develops. Trump's style is very unorthodox, as we've seen so far, and we've had very volatile trade policy from the U.S., and we'll just have to see how that develops in the coming quarters.
All right, Paul, good conversation. Thank you very much. Appreciate you joining us here
My pleasure.
on CNBC-TV18. Well, let's just quickly run you through what's lined up here over the next 2 hours or so. So, 8:35, the management of Sirma will be with us in the fourth quarter earnings. 9 o'clock, you'll have Gaurav Malhotra of Axis Capital to talk about the earnings from Bharti. And earnings are strong. 9:20, Krishna Sangvi of Mahindra Manulife Investment Management will be with us on markets. 9:30, PG Electroplus, another EMS company, on their fourth quarter numbers. Siva Chittur of Sai Life Sciences will be speaking with us at 9:40 on their earnings. Towards the end of the show, it's a special segment. It's the economy, and Lata will be in conversation with S&P Global Ratings and Neeraj Gambhir of Axis Bank on the impact of US-China trade deal on Asia and specifically India.
Time to slip into a short break. Got a lot of stock specific to track for you. Well, we are just going to run you through the top 10 list. Tata Motors, Bharti Airtel, Bharti Hexacom, Max Financial, Honeywell Automation. All of them will be reacting to positive news flow. Add to the list Garden Shipbuilders, Coromandel International, Nykaa. While we have Siemens, who will be reacting to the negative set of numbers, and crude sensitives as well. Expect a reaction out there. Stay with us.
Welcome back. So as we've been telling you, the cues across Asia are a little mixed. The implied open, however, has been telling us that we'll start strong, almost 80 points higher. So in sync with some of the markets like Hang Seng. Look at that, almost 90 points higher now. What about individual stocks? Lots of companies to look at, lots of earnings to go over. So let's straight away get to it. Our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Sudarshan, Tata Motors, it's all about these trade issues that are going on. But anyway, how's the company shaped up in Q4?
I'm going with mild green for Tata Motors due to two main reasons. First, Q4 earnings were largely ahead of expectations and outlook remains supportive. Now, talking about the earnings were ahead of estimates, but outlook remains cautious. And the guidance, if you talk about for Tata Motors, company will give guidance on June 9, that is Investor Day. And for JLR, the guidance will be given on June 16, that is Investor Day for JLR. Now, coming to the headline numbers for Tata Motors, both EBITDA and margin were flat if you compare YY, but it's higher against our estimates. For JLR 2, EBITDA margin was flat at 15.3%, but almost 100 basis points higher against our estimate. And for JLR, EBIT margin of FY25, company has reported 8.5%, which is almost in the line of the guided range that company had given. Now, going forward, what would be in the focus for JLR? First is the tariff increase. For the exports from UK plant, tariff increase is of 300%, that is to 10% from 2.5%. And for exports to US from EU plant, tariff increase would be 1,000%. So that would be in focus. For commercial vehicle, both trucks and buses segments have registered double-digit growth. But in the near term, company cost will increase because company has to transition truck business to AC. Now, for passenger, both SUV and CNG segment continue to do well, but hatches segments remains under pressure. But going forward, company believes that new launches that company is going to take in FY26 will support the growth.
Okay, all right. Thanks a lot for that, Sid. Well, let's hop across to Rima, who's tracking Bharti Airtel and Bharti Hexacom. Welcome back, Rima. Fit and fine. Go for it. How are the numbers?
So pretty good for both Bharti and Bharti Hexacom. So first for Bharti, remember the numbers are impacted because of a full quarter consolidation of Industars versus only 43 days in the prior quarter. That's Q3. We're looking at the numbers on a quarter-on-quarter basis. So that explains the big improvement seen in the consolidated numbers. So revenues have gone up 6%. EBITDA is up nearly 10% on a sequential basis. The bottom line is a lot of exceptionals. But if you strip that out, analysts say that the numbers are largely steady. The company continues to execute very well on the India mobile front. Revenues have gone up 1.3%. Their margins have expanded further to 59.2%. That's the India mobile EBITDA, 59.2%. ARPUs are steady. That's the average revenue per user at 245. Subscriber addition healthy at 5 million in the current quarter. So all in all, good set of numbers. Africa led to the beat, but Africa numbers were known. India numbers are pretty much in line with expectation. Conference call today at 2:30 p.m. Hexacom has reported a beat. Top line growth 1.7%, margins 53.3%, and the bottom line has been boosted by an exceptional gain of 82 crore rupees. Back to you.
All right, Rima, thank you very much for that. That's Bharti and Bharti Hexacom, and you'll hear from an analyst at 9 o'clock on these as well. Max Financial Services reported numbers. The insurer, Yash, is here with details. Yash, morning.
Well, morning, Prashant. So it's a double positive as far as Max Financial Services is concerned. I'll speak about the first one. Here, the numbers for the quarter have been very, very strong. A beat on all counts, if I may say so. Total AP that has come in at about 3,339 crore rupees versus CNBC-TV18 poll of 3,039 crore rupees. Retail AP is bang in line with what CNBC-TV18 had estimated. Value of new business, that's where operationally strong performance is coming. A strong beat and a growth of about 8%. Margins, again, on a year-on-year basis, they're up 45 basis points, but again, a very strong beat at 29.02% versus poll of just 26.06%. This is the first positive, and the companies ended the year FY25 on a very strong note, but the month of April has again been very, very strong over a strong base which the company had. So, of course, ending the year on a very strong note, starting the next financial year again on a very strong note.
Okay, all right. So looking good for Max Financial Services. Thanks for that, Yash. Let's get to Upasana now. Siemens and Honeywell Automation, two numbers from the capital goods and industrial space. Upasana, morning. How are they looking?
Good morning. First up, let me start with Siemens. Now, overall revenue was in line with Nomura estimate with a growth uptick of 3% on a YoY basis. Company's EBITDA, EBITDA margin and net profit, all three missed estimates. Now, it is also important to note that the demerger of the energy business is effective from 25th of March 2025 onwards. Now, coming to the company's overall EBITDA, it stood at 467 crores with a downtick of 27%. Company's EBITDA margin stood at 11% versus 15.3%, downtick of 430 36 basis points. Company's PAT stood at 408 crore with a downtick of 37%. Now, company's PAT declined mainly due to under-absorption of fixed cost and higher cost of material in the digital industries business. It is also important to note that PAT was also impacted by an extraordinary gain of 192 crore from the sale of property in Q2 SY24 and demerger expenses of 63 crore in the current quarter. Now, next up is Honeywell Automation. After the last few quarters, company missing consensus estimate. After several quarters, company has reported revenue, gross margin and EBITDA above estimates. Now, revenue saw an uptick of 17% on a YoY basis, 3% higher than the Bloomberg estimates. EBITDA stood at 159 crore, down 6%. EBITDA margin saw a downtick of 357 basis points, which was largely in line with the estimates, and company's net profit missed estimates due to higher effective tax. The number as 140 crore in terms of PAT with a downtick of 6%, 9% lower than the Bloomberg estimates.
Going with red, right, on Honeywell as well.
Green, I expect, and Siemens, I'm going with red.
Siemens is red, all right. Got the head of us, and thanks very much. So mixed numbers from the industrial stocks. Let's talk about defense names. Tall expectations here because the stocks have been going through the roof. Ria is joining in. Ria, Garden Reach Shipbuilders, at least optically those numbers were looking good. Tell us more.
Well, yes, good morning. Garden Reach Shipbuilders has reported quite a good set of numbers in this quarter. The revenue has gone up around 62% on a year-on-year basis. Even the EBITDA and net profit have jumped up by 144% and 119% respectively over the previous year. EBITDA margins have also seen an expansion of around 454 basis points, coming in at 13.5% in this quarter versus about 8.9% in Q4 of last year. For the full year FY25 as well, we've seen good growth on all fronts. The net profit margin has also been above the guidance of the company of over 8%. The order book details haven't been disclosed yet, but as per the Q3 earnings call, the company had said that the order book is expected to come down to around 22,000 odd crores at the end of FY25 as execution is picking up, and the order book at the end of Q3 stood at around 23,877 crores. Some key things to watch out for going ahead will be the management's comments on the order book and execution, and an update on their key project, which is the delivery of the 8 ASW shallow water crafts, all 8 of which are to be delivered by the end of October 2026. And remember, the first one was delivered just last week to the Indian Navy. So overall, good set of numbers for GRSE, and expecting the stock to open in the green today.
Okay, all right. Thanks very much for that, Ria. Now, the MSCI changes, and let's put the spotlight on some of those stocks where those revisions have happened. Vivek, take it away.
Well, that's right. So overnight or very, very early morning today, MSCI went ahead and announced the changes. This is as far as the May 2025 index review is concerned. The index that we track very closely is the MSCI Global Standard Index, where there are 2 additions that have been made, and there will be a significant amount of impact, especially in terms of passive fund flow. When will the adjustments take place? The adjustments will take place on 30th May 2025. 2 additions, no deletions. So when you're talking about the 2 additions, Coromandel International makes its way into the standard index. IIFL Capital expects close to $227 million of inflows into this particular name. The other stock is FSN E-commerce, or Nykaa, or more popularly as it is known as. Over $180 million of inflows is what IIFL Capital estimates. Along with that, there will be some stocks from the small cap and mid cap to in focus. MSCI small cap index has seen 11 additions and 22 deletions. So overall, Coromandel and Nykaa make their way into the MSCI Global Standard Index.
Okay, all right, Vivek. Thanks a lot for that. Well, let's hop across to Manisha. She's here to tell us about the crude sensitives because they'll be reacting to a bit of a pop that we've seen in crude oil prices. Morning, Manisha.
Morning, and thank you for that, Nigel. Well, yes, a 4th straight day of gain coming in for the crude oil prices. It's trading at a 1-month highs right now, while the US and China coming together for at least a temporary truce for the 90 days is something that clearly has been supportive. But apart from that, the markets also are looking at improved outlook on global trade flows. The fresh sanction threats against Iran also seem to be doing the trick that we have seen support come in for the crude oil prices. There are buying calls actually coming in for various banks and brokerages globally as well. The only thing to watch out for would be Saudi Arabia pushing for increase in production for the month of May and June. And it also says that they would penalize members producing more than the quota. So that is something that could perhaps cap the gains in prices. But apart from that, the last couple of weeks have been good for crude, and this one continues in the positive side as well.
Okay, all right, got it. Thanks for that, Manisha. Indeed, watching out for crude quite carefully now that it's back above 66. Quick recap of all the stocks to watch today. The ones that have positive news flow or earnings around them are Tata Motors, Bharti Airtel, Bharti Hexacom, Max Financial, Honeywell Automation, Garden Reach Shipbuilders, Coromandel International and Nykaa, green on the back of the MSCI edition. The only stock with negative news flow on our list today is actually Siemens because of numbers. The crude sensitive is obviously in the watch zone. That is OMC's paint stocks as well as aviation stocks. ONGC and Oil India could be reacting positively because of the surge in oil prices. Let's take a break on that note, come back on the other side, and we'll have the management of Syrma joining in to talk about their fourth quarter performance and outlook ahead.
Welcome back. Well, as promised, let's get to our first management on the show. Syrma SGS, we have with us Mr. Gujral, the MD at the company who joins us. Hi, Mr. Gujral. Good morning. Good to see you. Well, on the top line, it appears a little bit softish, but your margins were a pleasant surprise. For the coming year, that's FY26, do you stick to the revenue growth of around 30 to 35%? And do you want to up the margin guidance of around 7.5% post the last quarter showing? So give us both those two numbers, revenue growth, margins, and what will exports come in at? It fell short a little bit of in comparison to the 1,000 crores that you had guided earlier.
Yes. So if you recall, when we had had the earlier earning calls for the quarters, I had always advised and suggested that we should be looking the company for a year as a whole and not quarter on quarter. So the 12-point odd senior upwards of 12% EBITDA margin in Q4 is essentially driven by the product mix, where my industrial and healthcare accounted for almost 50% of my revenues. And these are margin accretive segments. We had guided that we would bring down the low margin consumer business to 35% of our revenue from 40% last year. We have achieved that. Going forward, we believe that for the coming year, we would be able to do a revenue growth of about 30 to 35%, which would primarily be driven by the product mix. If my high margin businesses go up, the revenue growth could be slightly lower, but it will be margin accretive. We had guided for a EBITDA margin of 7 on a blended thing for a year as a whole. We have driven 8 point something. On a conservative basis, I would guide 8% EBITDA for next year, which in rupee terms would come to about 400 odd crores.
400 crores. Just one more thing, sir. What about exports as a percentage of your mix?
Exports this year we were targeting, and I had shared with the street that we would be crossing the 1,000 crore marks, but they have been muted. We have almost been there where we are, though for a 4-year CAGR, we have grown at 15%. I expect to cross that milestone, which we should have crossed in FY25, in FY26.
So 1,000 crores in exports, that target remains.
Yeah,
Mr. Gujral, okay, got that. So Mr. Gujral, sir, for this year, FY26, you're saying that top line growth should be in the region of 30 to 35%, margin guidance of 8%. Let's talk about this product mix as it's changing, because you're bringing down the share of the consumer business. So what will drive the growth? I mean, how quickly can the industrial segment ramp up? What is the growth that you see ahead for industrials? Because that's your high margin business, right?
Yeah.
What kind of companies, so what kind of companies, what kind of contracts are you looking out for? And will, industrials, will that be driven more by local contracts and domestic growth, or will you focus on exports here as well?
Industrial would be driven both by local and exports. And in the domestic market, the key driver will be the smart metering business. Last year, we did almost like 4 million pieces of smart metering electronics. So growth in exports would primarily be driven by industrial and healthcare. Automotive exports are almost very minimal. So the growth in the coming year will be driven by the customers which we have onboarded and started commercial supplies in later part of this year. So I get a full 12 months in FY26 against maybe 7, 5, 6 months in FY25.
Right.
So can you just give that really helps, because your focus segments, very clearly as you're saying, are industrials and healthcare. So for these two businesses, what will be the run rate? Do you think you can grow revenue here, what, 20%, 25%? What would your target be for your teams for these two businesses, which are your focus areas?
So when I say that I would be growing my revenue at about 30-35%, consumer, I'm saying I'll bring it down. I'll try to maintain it at 35 or try to bring it down. So obviously, if consumer remains stagnant, which accounts for about 35% of my revenue, so the growth will be driven by the 65%.
Yeah.
And in this 65% is the automotive, industrial, and healthcare.
Yeah.
Apart from little bit of railways and IT.
Mr. Gujral,
segments would drive the growth. Automotive, healthcare, and industrial.
Yeah. Just a couple of questions, Mr. Gujral. On for industrials, you said it's smart meters, right? Is the major product which drives
For domestic. For domestic.
For domestic. So this is largely driven by the government sector, correct? I mean,
we don't supply to the government, we supply to the metering companies, but yes, the end consumer is the government.
That is all set, right? I mean, there is, for example, in Bombay, I can tell you, there is a lot of, in many parts of the city, there is a lot of opposition to smart metering. You know, big housing complexes, etc., written to the BMC here, opposing these meters to be, there is a lot of, I mean, you know, it's kind of back and forth. So, do you expect that to go smoothly since it's a growth driver for you?
Business with government, where the government is the end customer, is never a smooth ride. So let's be very honest about it.
Right.
But having said that, we have grown this year, and first 2 months also, the traction has been equally good. So I don't expect on a long-term basis a significant impact on this, and we believe this business would continue to grow at least for the next 2 to 3 years.
And this, you're making the meter itself?
No, we are making the electronics for the meter.
The electronics for the meter, got that. And the second is healthcare. What exactly are you making there?
So in healthcare, we are making the RFIDs and the end products. End products for maybe neonatal respiration, heart monitoring, beauty products, laser products. And there we have got a very good traction in design and services, which is very high margin accretive, and which results in long-term sustenance of the growth, because the product which I designed in 1 year, it will see production, commercial production in the coming 2-3 years.
Got it. All right. Got it. Mr. Gujral, very quickly, if you could tell us, you have taken an enabling resolution for a QIP. You intend to do it some part of this year?
Yeah, I think we had taken it last year, so that was expiring. We have taken it again this year.
But will you raise money, sir? Because you have barely any debt. So I was wondering why you're going via the equity route and not debt. What will it be used for?
Inorganic acquisition, which we keep evaluating in the sectors where we are not present, as I've already been saying. Okay. And now the component policy of the government of India has also come in.
Yes.
And we would be participating in that. We are evaluating that. And should we participate in a vertical which requires a capex higher than what my internal cash flows and other things can manage?
Yes.
That's why we have taken this enabling resolution.
So sometime
primarily driven at acquisition, inorganic acquisition.
And components.
And maybe something for the components if I find it that the funding requirement is more than what my internal cash flow generations are.
So you will raise money via the QIP route around 1,000 crores if both these two need to happen, inorganic growth?
Both or any one of them. Both or any one of them. Both or any one of them.
Both or any one of them. So QIP is something we look forward to. Very quickly, final number I'll ask you before we let you go. What is your current order book?
My order book is in line with the revenue generation projections, which I have shared with you, a 30-35% growth over current thing. So quantifying into the numbers, it will be 5,300 plus crores.
All right. Mr. Gujral, appreciate you joining in. We'll hold you to these numbers. The margin number is something that we'll hold you to, 8%. And I think 400 crores is what you said in terms of an EBITDA number for the coming year. And we'll watch out for that fundraise by the equity route as well. Time to slip into a short break. Up next, we'll have Deven Choksi, who will be joining in to give us a fundamental analysis.
Okay, welcome back. Let's just take a quick look at what the GIFT Nifty is doing, and it's a 90-point, much stronger start. This morning, as far as the GIFT Nifty indication really is coming through. Deven Choksi is with us, Managing Director at DR Choksi FinServ. Deven, good morning. Pleasure to have you with us here on the channel. Let's just start with the Tata Motors numbers which came through. There is also additionally at the margin this India-UK FTA, so maybe some of those high-end JLR cars are able to come to India at a more reasonable price. Just as a stock, how do you evaluate things for Tata Motors?
Yeah, Prashant. Good morning. I think the fourth quarter numbers on expected lines largely, I think, has taken the toll on the profits. But more importantly, having said that, I believe that I think the fundamentals of the companies are shaping up well. On one side, the prospects of JL are remaining more brighter than before. And as a result of which, I think the numbers, even in European territory as well as I think in other parts of the world, I think are likely to show up in the 25-26 financial year. Similarly, the situation remains, I think, positive on the commercial vehicle front. On the electric vehicle domestic portfolio also, I think given the kind of distribution reach, I think the company remains relatively more stronger compared to earlier before. So in my viewpoint, I think if the numbers have to be looked at, I think one will have to look at sequentially improvement in the numbers on a month-on-month basis as far as the volume is concerned in 25-26. And should that be the case, and particularly contribution from JLR portfolio, I believe things could look up very smartly for Tata Motors going forward.
Okay, all right. Hi, Deven. Good morning. Good to see you in. What about Siemens? Those numbers look quite disappointing. While Honeywell, in fact, the numbers look good out there. Any comment on either of these two stocks?
Yes, Nigel. Good morning. Well, I think not very easy to conclude on the quarterly numbers per se, because in many of the situations, and particularly in case of any capital goods companies, I think somewhere the offtake hasn't happened in the system because of the government's inability, I would say, I think, to implement some of the projects in time. And as a result of which, I think some of the capital goods companies have actually, I think, not been able to justify the numbers that they would have otherwise reported based on the order book that they had. So that could be one of the reasons for which I believe that I think some disappointment on a quarterly result basis. But I would like to believe that given the trajectory of growth and the government's commitment for putting money into the infrastructure, including railways in this case, I believe that the numbers could show up in subsequent quarters. But more clarity would probably be sought from the company on this particular front.
Okay. Deven, hi, good morning. We were just speaking to one EMS company. We'll be talking to another one soon. Sirma, I don't know if you caught a bit of that conversation or not. We'll be talking to PG Electroplast as well. What do you think? I mean, it all depends on which company is executing and growing fast, right? For instance, Sirma told us they're trying to change course a little bit, move a little higher up on the margin curve, look at high margin products like smart meters, etc. PG has been another good steady quarter. How do you find the stocks in terms of valuation and opportunity?
Yes, very good morning. Not sure about the valuation at this point of time because I find that everything seems to be in price from what numbers I saw. But importantly, I think in the EMS space, the companies are having relatively better time because the OEMs to whom they are supplying to, they are probably enjoying the best of the market times at this point of time. Maybe on a quarter-to-quarter basis, I think you may not be justifying those numbers, like I said earlier before in case of Siemens. But the fact remains that I think they are the ancillary companies which are supplied to the OEMs. In this case, I think the complete designing, manufacturing, and supplying the entire kit to some of the OEMs. I would think that the business condition remains relatively more stable for them, but not sure about the valuation of each one can buy at this point of time.
Deven, any view on Z? One of the biggest underperformers, I think, of the last 10 years or so. Every time there was some hope, the stock gave it away. Now, suddenly the promoter has gone ahead. I mean, they bought only 16, 17 lakh shares. On May 12th, that was reported on May 13th. So that could explain why the stock was up yesterday. They're guiding for better times ahead, but they've disappointed in the past. At around 120 rupees, would risk reward be favorable or you'll stay away?
Again, I think not completely sure, Nigel, because I don't see the moat in the business at current levels. And given the strength that the competition is providing currently in the universe, I think they will have a big time role to play in form of building the company back to the level at which I think the one would like to see it. However, I think at this point of time, I don't see that kind of a clarity. Maybe I think save and accept this kind of transaction. Some amount of re-rating may take place on the stock price, but not too sure whether fundamentally I can put money behind this company.
Devin, the theme yesterday which stood out even in a down market in a big way was defense. And the index, I think, ended about 4% higher, and so many stocks, BEL, BDL, and everything else actually, HAL, everything did quite well. What do you make of it? I mean, you think one should just let this, because this is on the back of recent events, and you got a bit of a sharp pull which has happened. The index itself is up about 10-12% since from the beginning, from before the beginning of this particular conflict. So let it cool off a little bit before you start to evaluate opportunities instead of chasing things here, or still looks good? What's your sense?
The long-term outlook, I think, remains absolutely convincing for most of the defense companies, including the NCLIs who are supplying to the mainframe business companies, I think, which are supplying ultimately to the government-owned companies. So in my viewpoint, I think there is no question asked on that aspect. I think the entire value chain remains quite interestingly positioned from the growth perspective. However, I think the market has priced everything in advance. In my viewpoint, I think some of the companies are quoting beyond FY27 earnings outlook. And that's where my concern would be. As I expressed even in past also, that I think these companies would be in a position to report a growth, but not beyond the certain premium above the GDP rate of growth. For example, if you are talking about nominal GDP of about 11%, some of these companies may end up producing growth between 15 to 20% at best. And if you are giving a valuation of 50, 60, 70, 80 times, then possibly I think there would be more disappointment or underperformance in the portfolio. That's where probably I'm a little bit more concerned about. I'm not doubting the ability to produce 15-20% growth. I'm possibly not comfortable with the valuation at which some of these companies are quoting currently.
Okay, all right. Valuations remain a concern, perhaps for some of the defense names as well. Devin, you tell us then, which stock or which company has been your earnings star in the fourth quarter?
It's a little difficult to pinpoint that part, but I think particularly very happy with the BFSI sector as a whole, in which I think we remain focused all along. And most of the companies, including SBI, including Kotak, I think we feel that the numbers have been probably better and in line with expectations. Maybe I think these companies are expected to produce relatively better performance year after as well, given the lower trajectory of interest rates. We believe that I think the growth rate could possibly be much higher in the BFSI space. So that's where I think we remain relatively more comfortable. I think in other areas, probably we are seeing the kind of growth happening in FY25-26. But at the same time, many of the companies have remained, I think, higher on the valuation front. Maybe I think in auto space and auto ancillary space, one can possibly look at a little bit more favorably and closely in ancillary space, where we believe that 25-26 could be, I think, comparatively better year to 24-25. So the focus is on some of the companies in ancillary space at this point of time.
All right. What we'll do is, Devin, take a quick commercial break here. We'll also look at the price action, which Sudarshan and Sachidanand Uttekar, who's going to be with us to run us through market technicals and what you should be doing. Stay tuned, coming up.
Welcome back. Should be getting the pre-open rates in the next 2-3 minutes. The indication is that we'll have a positive start. So let's talk about the trading strategies then. Sudarshan Sukhani and Sachidanand Uttekar are with us. Gentlemen, good morning to both of you. Sudarshan, so we had a pause day yesterday. What would you be doing in the market today? Let's talk the indices first, Nifty or Bank Nifty.
Good morning. See, the pause day was the day when we wanted to buy, and I had suggested somewhere around 24,650. The Nifty obliged us by actually reaching that and going a little lower. That's okay. So the trade is today, and we are opening roughly around those levels. So the trade is to be long in this market. We've had a minor correction, but the tactics also needs to be considered. You should be long, but remember that it is possible that markets may consolidate and IV, implied volatility, could come down. So manage your trades either by buying call spreads instead of calls, selling put spreads, and taking care of the fact that IV could be coming down even as the markets consolidate and start going up. But essentially, be long.
Okay, all right. And that was one of the reasons as well. The IVs were coming down, and that's why the VIX cooled off in a market that actually came off. Yes, it was down close to 300 points, but yet the VIX was down close to around 1% in trade. Thanks a lot for that, Sudarshan. You have been maintaining your positive bias. Sachidanand, coming across to you. Good morning. Good to have you on the show. Tell us, what's your trade on the Nifty and the Nifty Bank?
Good morning, Nigel. Good morning, Surabhi. Clearly, we saw some unwinding pressure yesterday in both the indices, Nifty as well as Nifty Bank. But if you look at the price action, the 5-DEMA support level was well defended. So if you look at yesterday's options data as well, we are seeing that there is a very strong support base at 24,500 for the Nifty. Corresponding level for Bank Nifty is placed somewhere close to 54,700. So we don't see that the markets would slip below this particular base, and we are expecting that eventually market should resume its up move towards 25,000, 25,180. This is our positional target. So from a trading momentum perspective, I think a conditional buy would be about that 24,640 mark, wherein some aggressive long positions for the day can be deployed. One can keep a stop loss at 24,590 on a closing basis, and expect a swing back towards 24,900 for the day. The positional target for the Nifty is placed somewhere close to around 25,180. When we look at Nifty Bank, 54,700 looks like a decent support. And on the higher side, we are expecting that Nifty Bank could also swing towards 55,300 eventually, especially if you look at the placement of the ADX. It is on a verge of breaking that 25 mark when we look at ADX 9. So I think both these indices are still placed on the positive zone, but the reward to risk opportunity looks better in Nifty for the day.
Okay, all right, got that. Let's talk stocks now, gentlemen. So the individual trades, Sudarshan, what are you looking at today?
Well, it's an all buy list. CDSL is a buy with a stop under 1296. Granules is a buying opportunity, stop under 452. LIC is a buy again, stop under 811. And Jindal Steel is a buying opportunity with a stop under 885. Mid caps spread across the different sectors, and a sense coming that eventually small caps and mid caps are slowly putting their act together.
Okay. And Sachidanand, your list?
So we like escorts. If you look at the way last two trading sessions have shaped out, we have seen a very strong V-shaped recovery here. The breakout was established at 3,500 levels, and the way the momentum indicators are placed, we are expecting that this particular rally may continue towards 3680. From a trading perspective, the target would be around 3560. One can keep a stop loss at 3470 and deploy long position in escorts. The second stock is HAL. There's a bullish flag formation on the daily scale. Again, a continuation pattern, indicating that price can get elevated towards 4770. From a pattern perspective, the target is placed at 4840. So the trading stop loss can be placed at 4570 on a closing basis.
Okay, Sachidanand, I'm glad you mentioned that because I was going to ask you about defense stocks very quickly. So, do you only see an opportunity in HAL? For instance, Garden Reach today is looking good. In the pre-open, it's up 4-5%. Numbers are good. Anything else in the defense pack? And is this a tactical trade? I mean, are these intraday or maybe 1 week positions, or do you see longer term trends also looking strong in these defense names?
Well, most of the stocks have been performing well. The other stock which we have recommended to our clients is BEL. Now, if you look at the overall, monthly scale, there's a strong, bullish breakout on its monthly charts, indicating that the stock can, elevate towards 400, 440 zone in the coming months. So I think this is one particular idea that can also be considered. Mostly, all these stocks are showing good signs of, momentum. But the other stock which we like is also BHEL. Now, if you look at the overall structure, we have seen that the stock was trending below its 200-day exponential moving average. But this week, it has managed to sustain above that particular level. And if you look at the overall construction, it looks like a inverse head and shoulder formation with a price target somewhere close to around 270. So I think this is also one particular stock that can be considered from a momentum perspective. The stop loss for the trade can be placed at around 230.
No, absolutely. Gentlemen, thanks both of you for joining us with that, setup and those trades, etc. as well. Let's talk about the telecom sector now. Bharti, of course, has reported a good set of numbers. What next for the stock? Gaurav Malhotra is Executive Director at Axis Capital. He's with us now. Gaurav, good morning. Prashant here. What stood out to you in the Bharti numbers, Gaurav, and what does the stock do from here?
In terms of the results were broadly in line with estimates, right? It was a very steady quarter. We saw some flattish ARPU, but that was more on account of lesser number of days, adjusted for which, the ARPU would have gone up by like 2% quarter on quarter, which essentially tells you that there is premiumization, which is an ongoing trend which continues, right? Margins were also for the mobile business are going at a steady clip, right? So the EBITDA to revenue sort of transmission is almost 80-85%, which is very healthy. Capex on the full year was lesser versus last year, which was expected. So the India mobile Capex was only 75% of the full year Capex of FY24. So on the whole, that also helps you, generate reasonably healthy free cash flows. The company has obviously doubled its dividend this year to 16 rupees versus 8 of last year. We would have liked it to be a little bit more, right? Because to put things in perspective, this 16 rupees is almost say 20% of its operating free cash flow and almost 30% of its PAT. So we would have, ideally liked it to be slightly more, but we'll see what the management says in the earnings call. So on the whole, a decent set of results, very, very steady kind of numbers.
Okay, and what is the stock traded? What is it pricing in, and what are prospects there?
See, the India business is not cheap, right? It is trading at around 13 times 1 year forward EBITDA. The last time the stock went beyond this was, all the way back, you'll have to go to like 2007-8, when the multiple was almost say 15-16 times. But at that time, things were different, right? The EBITDA growth was almost say 50%, 45-50%. So multiple-wise, it is trading at a premium valuation. But we do feel that while there is limited scope for the valuation to expand from here, but these multiples can sustain because of very, very predictable earnings and with strong earnings growth. And, now that the company has started to slowly increase the cash return to the shareholders as well.
Okay. So, then the question is, what next? And whether, Gaurav, there are further triggers ahead. Now, till we get to another round of, say, price hike, I don't know if you're factoring in one this year, because we had one last year itself. What would be the next triggers for Bharti?
Yeah, see, the next trigger will have to be the hike, right? And the way to think about is that, the ARPU transmission has been very strong for the operators in the previous hike. So when we say ARPU transmission, it means how much the ARPU rose versus the tariffs. So for Bharti, it was like 98-100%. For Jio, it was almost 90%. So we do feel that, going forward, given the transmission is very high, for operators to see a steady uptake in ARPU, they don't need to take a very high sort of tariff increase. So the last time the hike was almost to the extent of 16-17%. So maybe going forward, they will take a smaller increase, say 10-15%. But a smaller increase also means more frequent increases. So our base case today is that we expect a hike, say, in 1.5 to 2 years from the last hike. So the last hike was in June 24. So we expect it to happen somewhere between December 25 to June 26. And our ARPU assumptions are roughly around 9 to 10% CAGR over the next 3 years, premised on both tariff hikes as well as premiumization.
And I know we've discussed this earlier, but let me just ask again and put it on the table because the buzz is so strong, right? The Starlink entry. And I think everyone's saying that it's just a matter of days now before those services get officially launched and there's an all clear, unless something changes, because geopolitics can be a very, very different beast, a different animal, and there's too much going on. But as and when Starlink comes, is there any reason for shareholders of the listed universe, whether it's a Jio, whether it's a Bharti, for them to worry on the data front?
Nothing to worry at all, right? The ARPU of a Starlink, right, if you look just to a global comparison, is between, say, $25 to $30, right? Operators today, right, with all the tariff hikes, are roughly at like $4, $5, right? So this is even, forget the mobile, even if you look at from a broadband perspective, the broadband ARPU says $7, $8, right? And Starlink ARPU tariff plan will be between, say, $25, $30, or even $40 in some countries. The second is on the terminal cost, right? In India, the what we get at home, you know, the routers and all, they are essentially given for free. There is a security deposit of 2,000, 2,500 rupees. The terminal cost of Starlink is between 25 to 30,000 rupees. So this is going to be an extremely premium service for essentially high-speed data, which can be provided by operators both using fiber as well as FWA. So nothing to sort of worry about for the foreseeable future.
Okay. So I get it. It's maybe only, Prashant can maybe use those services exclusively, right? When you go on the private island, remote, no other form of network, then on the Starlink phone, maybe Prashant will make a call, right?
It damages the work-life balance for sure.
What did you say? I missed that.
It will damage the work-life balance. I was talking more from an access point of view, right? He can make that call. I can't. Definitely can't at those tariff levels.
I was thinking more like, trekking to Pune or something. But well, private island sounds better. Gaurav, anything else in your coverage universe which you want to sort of highlight as looking interesting?
See, from our coverage universe, we continue to like Reliance Industries, right? We feel that, that's one stock which has, which underperformed last year, has done well this year. But, that has enough legs, for it to sort of continue with its outperformance. Otherwise, within the telecom space, we don't like Indus. It's like sort of a neutral for us because we feel that, given the uncertainties which still remain around Vodafone Idea, that is a stock which, yes, the multiple is cheap, there could be potential dividend, but we would like to stay away from that for now.
You have coverage on Indus, Gaurav?
Yes.
And that dividend didn't come, but maybe it'll come. But what's your view? I mean, people have they were really pining for that dividend and holding on, etc. But yeah, go on.
So see, we were a little bit a candle in the wind when it came to Indus dividend, where we said that, look, given the uncertainties around Vodafone Idea, maybe the dividend may come, but not as substantially as what the street was sort of estimating. The street was estimating around 16 to 18 rupees. We thought that, the company may give you a dividend, but not to that kind of an extent. Obviously, the company has now spoken about setting up of a committee. So we'll have to see where things stand at. But definitely, that was a disappointment because the market was positioning for a dividend. And now there is an uncertainty around both the timing as well as the quantum of what the dividend could be.
All right, we'll leave it there. Gaurav, good conversation. Thank you very much. And, we'll have you back when the Starlink services are launched. And, talk more about that then. Well, no impact, though, in terms of incumbent players. Just, two on the other opposite side of the spectrum, really. Well, I'll just quickly run you through 9-10 calls as well. Sudarshan is back with us. Sudarshan, what do you have?
Well, I have considered buying Granules with a stop under 452.
Okay, Granules with a stop under 452. Thank you very much, Sudarshan. Well, let's go across to our Sudarshan now. Tata Motors is what he's focusing on. So take it away.
So in the pre-opening session, Tata Motors is down 2%. So while the company has reported Q4 earnings that were largely ahead of expectation, but on the back of cautious outlook, some of the brokerages have downgraded the stock. So I'll start with CLSA, which is positive on the stock. It maintains the outperform call and target is rupees 805 per share. It says Q4 earnings have met estimates, but JLR is cautious on demand in FY26, but company is confident in delivering on EBIT margin for JLR as well. Jefferies maintains underperform call and target is 630 per share. It says Q4 EBITDA is down 2% but 4% above estimate, and JLR may have tough FY26 on tariffs, increasing costs and rising competition in China. Nomura has downgraded the stock to neutral and target is 799, and Kotak Institutional Equities too has downgraded to reduce and target is 600.
Okay, all right. Thanks a lot for that, Sudarshan. Well, I'm looking at AB Capital. A couple of brokerages, they're quite positive on the stock. Macquarie, they have an outperform rating, target price at around 260 rupees. They say that the last quarter, that's the last quarter's numbers, the profit in AUM was in line with expectation. Now, all eyes on the slippages in the unsecured business segment, which they're keeping an eye out on. They also go on to say that on the insurance vertical, the performance is better than expected, and they're targeting to double the NBFC AUM as well as the VNB in the next 3 years or so. Morgan Stanley, they as well have an overweight rating. They have a target price of around 250 rupees. They say that there's a steady improvement and the better outlook across businesses. The NBFC, the largest part of their business, was in line with expectations, while the businesses are seeing the largest increase in estimates, and the valuations are, for life insurance as well as housing finance. They make a point on that as well. They see margins of safety along with the scope to re-rate from here on. So both the brokerages that we have, Morgan Stanley as well as Macquarie, fairly optimistic on the stock. It appears the leadership at the helm is making the difference out there.
Absolutely, Nigel, a point taken. Let's just take a look at I think we've got a minute and counting down to the market open. Maybe just Tata Motors, if we can take a look at quickly how that is starting. The pre-open is settled about 35 points higher. Tata Motors is down 2.5. Bharti Airtel and Bharti Hexacom, if we can just quickly look at, and then we'll look at Max Financial as well. Bharti is 0.5% higher. Hexacom will come up next. Max after that. And Max, of course, I think out of the lot, Max has reported a pretty good set of numbers. Hexacom is up 5%, so it's a more pronounced move. Max is up about 2.5%, as Yash was saying earlier. Honeywell Auto, maybe just a quick look at that one. So again, reacting to earnings. They're all earnings. Garden Reach Shipbuilders perhaps is another one we should look at as we wait for market open. So that's 13.5% higher on Garden Reach Shipbuilders with regards to that reaction. At least that's a pre-open. But we'll have the actual open coming up in a minute, in a few seconds actually. We'll look at those stocks. Indices first though. So it's 24,642 on the Nifty, about 0.25% higher. The Nifty Bank is up about 0.4%, so stronger. Nifty Bank, of course, was down far less as compared to what the Nifty was. The mid-cap index is up. The small-cap index I can spot is about 0.75% in the green. Those indices were actually up on the day, even as the Nifty and Bank Nifty were lower. Otherwise, what? I mean, it's overwhelmingly right out of the gates positive for the broader market as well. I can see 1,500 stocks still opening, and maybe too early to point this out, but 1,500 up and about 250 stocks are lower. The heat map perhaps gives you a quick sense of how the Nifty pack is opening, and then we'll of course dive into individual names. That's the heat map. So about 14 odd names, 15 names in the red. Everything else is starting higher. Surbhi.
Okay, so like I said, the market in a bit of a what next mode, given that the two mega events are behind us now. 40 up on the Nifty. It's a lot more muted than what the implied open was suggesting. Tata Motors is cooling off quite sharply, 3% lower. Q4 was fine, but it's the commentary and this whole global trade uncertainty that's the bigger talking point in the commentary, and the market's reacting to that. Cipla is down about 2.5%. The broker updates have come in after numbers. In fact, we'll talk about this as we go along in the show. Hero Moto, Asian Paints, there's some more stocks that are losing ground. Eicher Motors a little quiet, subdued ahead of its numbers. M&M is also on the back foot this morning. The Bank Nifty is also very quiet, gain of less than 0.2% on the Bank Nifty. So what is working for the market? Bharti Airtel for sure, 2% after numbers. Tata Steel is carrying on its good form. International markets have been looking good on the China-US trade deal, 2.5% up on this stock. Coal India is also looking good, JSW Steel. So basically metal and material stocks, they're having a good session. The Nifty is being saved by the likes of Reliance, L&T, ICICI Bank and SBI. It's these four stocks really. Otherwise, the picture could have turned into red. But Reliance is having a good morning, 0.5% up. And the banks sitting on the fence, but mildly positive right now. ICICI, SBI at least, showing some green, but a bit tentative overall for the market, Nigel, today.
Well, that's right. I think it should be actually a very good trading session. Let's see how that goes from here on. To highlight a few stocks that are moving around, though, from the broader markets, we have GRSE, that's Garden Reach, that's flying away. Kochi Shipyard as well as giving it company on the upside. And Dalmia Bharat Sugar, well, that's the other one that's actually doing well. The numbers were ahead of DAM's estimates. The revenue rose by close to 35%, which was driven by a good growth in the sugar segment as well as the distillery businesses. So that's why that stock is doing well. You have on the flip side, you have Paytm. Well, there was some hope that maybe, in fact, it could get included in the MSCI reject. That wasn't the case. Now all eyes on the next review, which comes in August. And Nuvama saying maybe there could be a possibility it gets included in the next review. For the time being, though, the stock is under pressure because it didn't get included. So keep an eye out on that one. VIP, the numbers were absolutely horrid. Though the stock is only getting away with a 3 to 4% downtick. So we'll have to keep an eye out on this one because it's seen massive delivery-based buying over the last few days. And it has a con call today at around 2:30 p.m. So that one's on the radar. Sigma SGX, good margin performance. However, the revenue number was below what the street was working with. So that's why that stock is getting clonk bang. And IQ Lighting, that stock is down 6%. Because those numbers as well were rather weak. And giving it company on the downside, I think there's VST Tillers as well. So all these earnings reactions, so the stock is down. Sigma, VIP, VST Tillers, as well as IQ Lighting, all of them lower in trade.
All right, so yeah, it's a now I think 75-point higher start is what you have coming through. And it's looking pretty decent all across. I mean, I think the broader market especially, I think, deserves a mention because that is where yesterday as well, it didn't look like the market really missed a step. I think let's just bring in our market master. We have Krishna Sangvi now joining us, CIO Equities at Mahindra Manulife Investment Management. He's with us here in our studios. Krishna, great to have you with us here on the program. Thank you for dropping by. So just, the common refrain when you talk, because the market was down very sharply, it's now come up very sharply, especially, at least on the HNI side, when you speak to people, they say, well, there's no really big ideas now. I mean, it's kind of happened. And now, of course, long term is long term, but I'm saying from here and tactically or even slightly near term, medium term, it's kind of done in that sense. Would you agree with that, or you think there are still meaningful dislocations one can take advantage of?
It's really tough to decipher this. So you always need, in markets, we need to have two connects. One is what's happening in global markets. Other is what's happening to Indian markets. So if we analyze the global markets behavior, I think India more or less replicates the trend, if not the intensity, or maybe both at times. And that's what has played out if you look at this particular entire period of whether you look at tariff or even, last 3-4 months. I think so directionally, maybe that color or the signal, I think comes more from global markets. And that's where globally every market is, back to what they were 2-3-4 months back. And so is maybe Indian markets. So that's, on the market flavor, I think from a company specific, you'll always find some pockets where either there is a valuation upside or there is some sort of a earning expectation change based on what, the new environment keeps on offering. So as a macro level, yeah, if 6 months back at a similar level of Nifty, if the worry was that we have some sort of overvaluation in some pockets, I think that worry is not typically changing because that's what,
that's what I'm saying.
Pretty much same.
The background to my question was, you just assume for now that everything is slightly better now. Overall, things are better. But even with that, stocks have kind of reset. So is there a lot of dislocation really? I mean, something should trade at this and, it's unnecessarily very cheap now. Do you find a lot of opportunity, those kind of opportunities now?
It's difficult. Yeah. I agree. But that's not honestly true at any juncture in markets, right? So if you look at, I think small cap still remains little bit on the valuation side slightly higher. But yeah, typically large cap does offer a value.
But Krishna, to supplement Prashant's question, and we're not trying to be very glum and bleak over here. I know we're sounding like that. But I'm going to ask you a glum question as well. Maybe it's good, right? When everybody is glum in the market, that's when the market surprises. Now, the other thing is that if you just go back, say, 5 years, COVID onwards, there were always very strong narratives in the market.
Yep.
Before COVID, it was all about financials, right? You ride that bull run and it was easy to make money. During COVID, it was IT and pharma. After COVID, we had this government capex theme coming in. So it was defense, it was railways and capex stocks. a very clear central theme seems to be missing in the market right now. So is this going to become a bit of a grinding, nerve-wracking kind of market? And to add to that, you were saying that there are not too many valuation dislocations, which are very easy, like a plum catch, as they say in cricket, those opportunities. So is this going to become an increasingly tough market to make money in?
No, I think markets are typically driven by narratives. The unfortunate challenge in the Indian markets is that the narratives are shifting pretty fast. Generally we call it as a sector rotation. If you really analyze, last maybe even 2-3 years entire period, you got a nice window of 2-3 months a particular sector drives the market, and then suddenly the relay race back and move somewhere else.
Yeah.
So I think that's a slightly different set of worry on markets, which says that the market participation route taken by investors in India especially is more of a leverage participation. And in a leverage trading pattern, if people want to follow, their time frame by default is short. Now, if from an institutional perspective, obviously we're buying long term, but we also have to go through those price moves on a shorter end because the other side of participants, are typically.
No, I'm saying from an idea perspective, you don't have to think too much. The market was giving you narratives. You just had to find maybe good companies, slightly better valued, clean companies in that theme, and you could make money. Is that time over?
No, maybe that our need for narrative is dominating, but the bigger narrative is clearly the same. India is a growing economy that 10%, 11% nominal GDP growth rate, which honestly has been the core narrative for the last 25 years.
So we go back to the mother narrative now. India's a growth story.
That's a real narrative.
Absolutely,
right?
absolutely.
Everything else is a deviation or a shorter term orientation by some set of investors. And let's look at markets the other way around. Monday was a great day for all of us, nearly 4% rally. If you look at the cash market behavior, we had what? FIIs, net buyers, DII, net buyers. So aggregate number was just 2,700 crores. Now just come to think of it, market of our size and, market cap, $5 trillion plus. And, you move by 4% on a 2,700 crore net cash buying. So which means clearly the driver is the leverage participants and their own ability, as they say, in a leverage, your ability to hold perhaps is a function of your risk management rather than your view. So somewhere, some of those things get triggered, but I think the core philosophy is intact for an investor. The challenge is when investor decides to take slightly more bolder call by taking a leverage route to the same pattern of investing. And then, those things happen.
In fact, I take that point on board, Krishna, because in the run-up to that entire skirmish on the border, we did see a lot of HNIs and retail participants that raised cash. And the last few trading sessions, actually, you've seen an outperformance coming from the broader markets, which is telling you more of the domestic money is at play, not institutional. That said, if I look at a couple of numbers, particularly from the commodity companies, yesterday I spoke to Tata Steel, and the management sounded very optimistic after a while. Yep. The stock ended lower yesterday, but some of these commodity stocks could do well. On the domestic front, you have the safeguard duty for ferrous names. And internationally, it seems a more rational Trump is what we're looking at right now. How do you view it, and what do you like, ferrous, non-ferrous?
Sure. So I think if you look at the current quarter result itself, we for a change have a season where the commodity companies are actually, driving the aggregate result season by a wider, YOY growth. So that's, first good sign. Clearly some supportive system, let's say on ferrous through the anti-dumping is in place, and as it gets played out, there's something positive there. Even that global factor, like a couple of months back or 1.5 months back, the worry was some trade dislocation. Yes. Which can impact consumption of commodities globally, and that's why some sort of price action happened there. Now, come to think of it, over the weekend we had nice series of announcements, almost everything happening same time, and so to that extent, yeah, commodities also is a good trade because the world is back to it's what it was supposed to do in terms of
for the time
growth.
being.
Yeah.
For the time being.
Because
and you prefer
events
ferrous,
are changing very fast.
Right, and you're saying you prefer ferrous.
We typically prefer ferrous, non-ferrous both, but yeah, way the anti-dumping duty has been played out, it gives a nice visibility. Again, let's wait. It's just a 200-day for now. The larger time frame of next 3 or 5 years can come in as the new order gets revised or changed. Let's see what happens there.
Have you discussed within your team defense as a theme, so I don't know. It's difficult we can talk about it, to actually put money behind a theme, as Surabhi said, the narrative. And you said, well, those are sometimes those are fads, and you kind of it's too difficult to say when the fad stops becoming a fad. I don't know if it's a fad, but what's your sense? Defense
I think,
specifically.
we got to differentiate this fade between the business versus the stock price linked, right? If you look from a business perspective, what's changed in last maybe 3 years, 4 years, especially post-COVID, when this entire talk of Atmanirbhar Bharat and the government stance saying that I need localized, purchase, maybe, entire direction was changed. And a lot of Indian companies are entering that, space, whether in public sector or private sector. So that's a core business momentum of defense, and not only Indian companies can do it for India, but they can possibly start thinking of some exports, etc., as and when, things play out. Now fade part may be more linked to the stock price, which is in a way valuation worry rather than a business worry.
No, so have you tried to link both? I mean, are they meeting somewhere at a reasonable level, or have stock prices run up too far?
It does offer you opportunity. It's just a question of every day it will never tell you, because markets are never, going to give you exit repricing.
You have exposure in this space.
Yeah, we will have some exposure across, companies, across our funds.
Okay, let's talk growth. Where else are you seeing at least not outlandish, outlier growth, but at least reasonable, sustained growth? Because that seems to have become a problem for large pockets of the market, whether it's IT, FMCG. We're all crying about growth. Auto, we're just crying about growth.
Oh, I agree. That's clearly a challenge of last, 6-12 months. And that's a thought process really, is that as, government, actually the monetary policy has gone into a favorable accommodative stance. That's the situation in which can ease those, growth concerns, is a core thought. And otherwise, nominal GDP, credit growth are more or less converging. All you need is a little bit higher capex, which can possibly, have the credit growth higher than the nominal GDP, and that drives a lot of other space in the market.
Okay, all right, Krishna, we appreciate you coming down and in fact giving us all of those views. Look forward to chatting up with you soon. Well, for the markets, though, we are trading well in the green, Surabhi. 150-point uptick is what we're seeing on the Nifty. The Nifty Bank is doing a relative underperformance, but the real game actually is in the broader markets. And that's been the case for the last few days as well. The mid-cap index doing very, very well. Breadth of the market looking extremely strong.
Absolutely. And don't keep your eye off on the defense stocks, because it's not just Garden Reach, which came out with very good numbers. Garden Reach's profits have doubled. Top line has grown at 60%. But it's carrying others along with it. Look at Zentech. Look at a name like Cochin Shipyards. This is still very much a sort of a lively, buzzing part of the market, defense in trade today. But for the time being, we are going back to the EMS space and putting the spotlight on yet another company you just heard from Sirma. Now it's time to tell you a little more about PG Electroplast, because the company also came out with numbers. Fourth quarter was a fairly strong one for PG. Healthy revenue growth and margin expansion as well was witnessed. So let's talk about this performance with Vikas Gupta, MD at PG Electroplast. Mr. Gupta, thank you so much for joining in. It's been a good quarter. And for our viewers, I just want to put up the FY25 performance as well. Good quarter and good year. In FY25, you've grown at 77%. Your margin is almost touching 10%. So, sir, let's talk about the outlook on FY26. Just break it down for us in the room AC segment and, washing machines, etc. What do you see ahead? Because there's been some concern, particularly on air conditioning, about the weather, perhaps dampening demand in some pockets in April. Your thoughts on how this year has opened out for you?
Good morning, Surabhi, and thanks for having me on your show. Specifically, when we talk about FY26, we have already released a guidance where we are saying that we will grow our revenue again by almost around 30 to 35%. And when we try to break it down into each product categories, like last year in air conditioners, we did a revenue of almost around 3,000 crores. And this year, like in FY26, we are targeting a revenue of almost around growing by 35% to almost around 4,000 crores for air conditioners. Similarly, in washing machines, we did a revenue of almost around 440 crores. And this year in FY26, we are targeting to grow that business beyond 600 crores. We are targeting almost around 650 crores coming from washing machines. So all those product categories are kicking in well, and we are confident that we should be able to give the revenue growth of 35% for the FY26 for the full year. regarding the demand specifically for the air conditioners, yes, definitely there has been some kind of a slowdown on the industry level. But for us, specifically when we talk about PG Electricals, because we are serving 35 plus brands in air conditioners, and we are confident that in the kind of order book that we have with the clients right now, we are confident that the revenue will grow.
But tell us one thing, Mr. Gupta, and if I look at the growth trends as well, it's a little volatile. I mean, you've had years where you've grown the top line at 100%. In FY24, it came down. Last year, it was 77%. Now you're guiding for 30 to 35. Why is your guidance of growth for this year lower than last year? And this is when you're commissioning new capacity as well. I believe there was a line that was commissioned just earlier. So what is the steady state of, let's say, CAGR growth, top line for PG over the next 3 years? What should we expect? And why are you more conservative on FY26 versus the last year?
So, Survi, please understand, we are releasing a guidance based on the current visibility and the current order book that we have with our clients. You have seen in past also, we have been upgrading or revising our revenue guidances. So we feel that we will keep on updating you in the coming quarters. But as of now, the growth that we see is almost 30 to 35%. And regarding the horizon for next 3 years, we are confident that we should be able to maintain a CAGR growth of almost 35% going forward as well.
All right. Hi, Mr. Gupta. Good morning and good to see you. But, I need to compliment you as well as the team. I recall 3 years ago, there was no institutional holding as well in the company. And now because of the fundraise and the likes, you have 25% from institutional itself. So clearly, there's a lot of interest in the stock. Now, one factor that I want to focus on is your CAPEX. The CAPEX for the year, I believe, is around 800 to around 900 crores. Could you break it down for us between RAC, compressor, washing machines and plastic? First, break that down. Then I have a couple of more questions on the compressor segment.
So, Nigel, good morning. So what we are trying to do is now the CAPEX that we have planned for this year for 800 to 900 crores. Please understand, we are trying to position ourselves for the next round of growth in next 3 to 4 years. So we are trying to build up more plant, we are acquiring more land parcels. We are building up new buildings. And so that will cover the majority part of the CAPEX, like almost 600 crores will go into the acquisition of new land parcels and the construction of new buildings. When we talk specifically about the product categories, like we are targeting a CAPEX of almost around 350 crores to 400 crores in the RAC segment, which covers the compressor part as well. In washing machines, we are targeting a CAPEX of almost around 100 crores. And in refrigerator, there will be a CAPEX of almost around 160 crores on the plant and machinery side. But if you look at the total CAPEX, which includes the land and building, the CAPEX should be almost around 300 crores in refrigerators.
Okay, all right. I want to focus specifically on compressor. That's the talk of the town, right? You announced this more than a quarter or so ago. But what's stopping you from announcing the JV partner, sir?
So, Nigel, so we have not closed the agreement part, which is still under the legal vetting, which we should be able to close in next 2 to 3 weeks' time. On the background side, we have already started the working with the technology partner to develop the building and everything. So that work is still going on. And we are still hopeful that there will not be a much delay in that. And we should be able to start the mass production for compressors by January of 2026.
When do we announce the partner's name?
So we should be able to do that in next 2 to 3 weeks' time.
Okay, all right. We'll have you back on the channel then at that point of time. But just one more question on this compressor part. If you assume 100% compressor will be used for captive consumption, then what's the kind of, peak, say, gross EBITDA margins the company can achieve? Suppose you assume everything is used captively.
So, Nigel, I'll just make a small correction on that. So we are putting up a 5 million capacity in phase 1 for compressors. And in that, almost 50% will be used for us. Like almost 2.5 million compressors will go in for captive consumption. So that will be a margin accretive. I may not be able to give you an exact number by how much margin expansion will be there. But balance 50%, which will generate a revenue of almost around 750 crores, go for sales to the outside customers.
All right, but rough margin difference in basis points, I think you can give us a band, Mr. Gupta.
So
captive versus...
So we should be able to see margin expansion of at least 1.5 to 2% in that case.
150, 200 basis points. Got it.
Got it. Vikas, hi, morning. That partnership for compressors, is that with Highly?
So, Prashantji, it will be difficult for me to comment on that. We are still not able to close that legal agreement, so I may not be able to make any specific comment on that.
Okay. The reason for viewers, the reason I asked about Highly is because most of the compressors that you kind of, you ramped up your, during the compressor shortage, I think you got them from Highly, and there was talk that, you probably will tie up with them. But I understand, we'll wait for that agreement to be closed. And we'll get you back on as well. On plastics, because if you can tell us a little bit more, what exactly, which segments are you doing? What are you doing right now?
So the plastic molding is also seeing a very strong momentum for us. Like it has surprised us also. And this year, we crossed 1,000 crores of revenue in plastic molding only. What we feel with the current geopolitical situation and with the tariff thing going on, we are seeing a lot of RFQs. We are seeing a lot of queries for the global requirement from our international clients. So we feel going forward, the plastic molding business should also maintain a good, healthy growth rate. And we are hoping to crack some good global business also on that front.
Are you, by the way, Vikas, going to look at, or are you already kind of working on this entire GLP-1 opportunity in any way? I mean, injections and that kind of thing on the plastic side?
So,
nothing.
No. So not on that side. So we have some clients which are our existing clients for India market. We are exploring some their global requirement RFQs as well.
But would you be open, since this is a new segment and it kind of is expected to have a very long runway, would you be able to pivot to it? Have you looked at it at all? Or this is completely sort of, away from what you want to do or what your capabilities are?
So, Prashant, as of now, we have not explored that, but going forward, definitely we are open to new ideas as well.
Okay. Mr. Gupta, just 2 quick points on margin. You've already given us a hint, right? ACs are such a large part of your business. And that business will see margins expand maybe more than 100 basis points as you start using these in-house compressors. Overall, for margins, you ended 25 at about 10%. So 26, 27, how should we expect the margin profile of the company to change? And also just tell us, in terms of the PLI for this year, with this electronics PLI scheme being announced, are you hopeful of getting any PLI benefits this year?
Regarding the margin specifically, if you look at, we have given a guidance on the PBT level also for FY26. We'd like to stick to that. Please understand, Surabhi, so we are in a contract manufacturing business. We cannot expect a very high level of EBITDA margins in this because, again, this is a contract manufacturing business. Okay. Regarding the electronic component manufacturing scheme, this is a scheme which has come out recently. We are also trying to go through that. And we are looking to participate in that in certain component categories.
And in which categories do you think you'll be eligible? Where would this be of interest to you, the electronics PLI?
So the electronic components manufacturing scheme, we are looking at least 3 to 4 components. We are talking to various potential partners in that. And we should be able to make some kind of definite comment on that maybe in next 3 to 4 weeks' time.
All right. And also, besides the profit and loss account, your net working capital days have come down a little bit, I think by around 5 to 6 days. Could you tell us what is the outlook out here and is there further scope for improvement?
So what we feel, Nigel, as before the ramp up for this season, we try to build up some inventories in our to take care of the AC business. So what we feel as the component ecosystem starts developing and the compressor thing starts coming out, so we should be able to further normalize our working capital days.
All right.
You want to give us a number, sir?
So it will be difficult to give any specific number on that right now.
All right, because we leave it there. We wish you all the best of luck as you and your team continue to execute and look forward to our next conversation. Thank you very much for joining us. So that is PG Electroplast with some perspective. We're up 140 points, so 24,700 is back on the table. So it's been a week so far, and this is Wednesday, a week of big moves. 900 points up on Monday, beg your pardon. Yesterday, it was 350 points down. Today, it's 145 up. So, it's got everything going for it this week in terms of just the drama and the big moves. We'll take a quick commercial break here. We'll have the management of Sai Life joining us on their numbers and more. Stay tuned. Okay, welcome back. We got the market, which is up 170 points, 5:1. I think now it would be a good time with about 30 minutes of trade behind us to look at market breadth, advanced decline ratio, and that is looking very, very solid. So 2,000 stocks are up and about 400 stocks are lower. So this is looking like a one-way session. And so much is happening with regards to individual movers, which we will come to in a bit from now. Okay, let's talk about the next company on our radar, and this is Sai Life Sciences. Earnings came through, earnings performance for the fourth quarter, healthy revenue growth and profit growth, but margins have contracted a little bit. There is, of course, the entire sort of, Trump back and forth, the executive order with regards to onshoring manufacturing to the US, etc. Sai Life, of course, is one of the largest CDMO players, and they are expected to be one of the prime beneficiaries if the CDMO space, as many investors believe, will pick up and, in terms of share gains, etc. Siva Chittur is Chief Financial Officer at Sai Life, and he's with us now to take some questions. Siva, good morning. Good to have you with us here. Thank you for your time. So let me just get that Trump question out of the way. With what we've seen so far, will it have any implication for Indian CDMO players at all?
So, none of us know what exactly will be the final outcome. With that as the preface, I think what this is leading to from our judgment is that there's a lot of uncertainty and uncertainty with respect to outsourcing into China. In our mind, the way this will play out is more the uncertainty, the more the need for diversification. We believe that there could be, a movement up and down here or there for a quarter, just depending on how things pan out. But we believe that the longer-term trend is towards diversification from China. And I believe that Sai Life Sciences, and not just Sai Life Sciences, but I think the industry will benefit from this uncertainty and the need to just mitigate from a pharma outsourcing strategy.
Siva, how much of the work that you do happens onshore in the US?
So we have a biology lab that actually is a smaller portion of our business. This is primarily into exploratory biology. This is, our feed into our discovery business, which is performed very well, and that's what we do in the US. Manufacturing a larger scale, R&D contracts are delivered out of India from an optimal cost perspective.
So you do the discovery in the US and then you kind of manufacture here?
Yes, portions of discovery in the US and then do the large scale, both R&D and manufacturing out here.
So, Mr. Chittur, hi, good morning, Surabhi here. If I talk about your revenue overall, the revenue pie, what would the exposure to US be at this point?
So, very good question. The only problem with that model is, right, in a generic business, it's very easy for you to kind of provide what that number is year on year, because shipments that are made to a particular country are based on export filings that you do in a particular country and generally are not sellable in another country. Versus in the CDMO CRO business, you could be sending it to, let's say their corporate office, which is probably located in a different location, or you could be sending it to another CDMO, which is probably finishing up a formulation.
Okay, got it. Let me rephrase the question then, Mr. Chittur. Let me rephrase the question. How much of your order book comes in from American pharma companies?
I would say, 20% of our business would come in from there.
Okay.
And it changes year on year, so it's not a constant number, though this can change year on year.
Sure. No, got it. It just gives us a reference point to work with. Now, for this business, which is 20% of your overall pie right now, is there a risk, because if regulation keeps changing and now there is this executive order, I mean, tell us what you think of it, or tomorrow if there is a demand to sort of onshore more of the work, wouldn't this 20% of your order book be at risk?
Good question, Surabhi, but I think there are two things that are needed to run a CDMO or a CRO business. One is people, second is a lab or a manufacturing location. For somebody to come back and put a manufacturing location or an R&D location takes time. This is not an immediate thing. This is probably a 3, 4, 5 year period. The second thing is about number of people needed for R&D, the number of people needed for manufacturing. We believe that the Asian locations have a lot more ability to put people on in demand. I think there are multiple things, right? On one hand, we are seeing a statement about bringing manufacturing in-house. On the other hand, we are also seeing statements that cost of the new drugs should be reduced. So at this time, without going into what it means, we feel that there are contradictions to it. And we believe that this is not going to happen at least for a reasonable frame of time. And more importantly, their need, immigration is getting tighter. Their need to kind of have people to be able to do this business, in our opinion, is for a large scale that pharma today is looking for, I don't believe is there.
Okay, so you're not too perturbed at this point in time. Got that, and you've explained the reasons why. So I just wanted to get to the numbers and in this guidance. Guidance you've given is 15 to 20% CAGR growth over the next 3 to 5 years, and margin expansion from 24. You're hoping to take the margin to 30%. What will drive that? Will it be high-profile, avenues like GLP-1? Will it be some other specialty drugs or some other form of research? What will drive your margin to 30%?
So I think margin will get driven. So this is a projection we gave at the end of the last quarter. We said our revenues will grow 15 to 20% CAGR over the next 3 to 5 years if you actually look at it. And then we've taken a target of 28 to 30% EBITDA in the next 3 years time frame. A large portion of this will come from operating leverage on account of expansion of the business. And that's really what we are seeing today. If you look at what we did last year, we were a little about 20%, and then we ended this year at 25%. So there's a jump from 20 to 25. So what we had told the street at that point in time is that we will take 2-3 years to get there. But you see the movement from 20 to 25, we've already done, more than halfway from where we were last time.
Siva, can we so on a CAGR basis, can we see 20% kind of revenue growth and 25% kind of EBITDA growth for the next few years?
So as I said, the business in the CDMO sector is a little lumpy. There could be a year where you're probably going lower, and there would be years where you're probably growing higher. That's why we gave you a CAGR over a 3 to 5 year period, and we are confident that we will get there.
Okay. Just talk to us a little bit about GLP-1, if you will. Are you a player in that segment?
Very difficult to comment because we are bound by a confidentiality agreement. But all I can tell you is any player in the CDMO segment, given the number of pharma customers who are working on the GLP side, not just the injectable, oral, there are multiple things. Other than those couple of drugs in the clinic, in the commercial world, there is enough on the pipeline. I believe anybody who's working in the CDMO sector is probably touching some GLP-1 at this time.
But it's not.
I would not be able to specifically comment on whether Sai Life Sciences is part of it or not, just given our confidentiality restrictions.
No, I'm not asking you to name companies, but you can at least confirm whether you are. I mean, I don't think there's any problem with that, right? You can tell us if you are involved or not.
I think we would prefer not to comment on specific modalities that you're working on. That's why I'm saying that any company working in this space is probably working on something there.
Okay, all right. And I'm assuming this will be on the fill finish side, right? I mean, but of course, okay, we won't go into specifics, as you said, maybe at some point when you can. Surabhi, you have another one?
No, I think we've got the gist of it. Thank you very much for joining in, and I wish you all the best for the year ahead. Thanks for explaining the business dynamics to us. So still sounding fairly confident. They do have 20% exposure to the US, but they're saying that these things cannot be shifted overnight, even if there is a cry for more onshoring.
So be that 20% number, just to put it in context, I think the 20% is revenue coming from US companies.
It's the order book. I specifically said out of your order book, because he said that revenue, it depends on where we are shipping. It's booked at that point. It may not be the US, etc.
Yeah, my only small point is that, if this were to, the US Trump actions, etc., has to impact, if it has to impact, I'm not saying it is, that number will be much greater than 20%, because that depends on what you're selling into the US.
Yeah.
It can come from Roche, which is a European company. It can come from Novartis, which is a European company.
Absolutely.
So that 20% is a smaller number. The actual impact has to be the percentage of sales which you asked, but we didn't get the number.
We didn't get that number. That's true. So let's see how this plays out. But for the time being, the company is saying that it's on track for further growth. Speaking of, tariffs and trade and all of these uncertainties, let's take that discussion forward. We have Amitendu Palit, Senior Research Fellow at the Institute of South Asian Studies at the National University of Singapore, joining in. Thank you very much, sir, for being with us. And, we here in India have been watching the headlines, obviously the big US-China thaw that's happened. But my first question to you is that given the developments in the subcontinent over the last 7-8 days and the geopolitical escalation and the US's stance on it, the statements that we've seen coming out repeatedly from the president, from J.D. Vance, from others, could that cast a shadow in any form on the India-US trade deal that is still being, deliberated? I think the Commerce Secretary is going to be in the US in the next couple of days.
Thank you, Survi, first for having me on this show. A pleasure being here with you guys. I think there's a dangerous trend that we are getting to see here, which needs to be looked at very closely. There is a tendency to connect trade with everything. And particularly when issues of bilateral conflict get connected with trade, or trade is taken as an instrument for resolving these issues or perpetuating with these issues, it's not a very healthy trend, because then trade does not remain market-driven anymore. Trade gets completely tweaked by other considerations, and that's not the way trade should be. Certainly, it's not the way trade can be done to benefit people. We see that having happened earlier. We see that having happened with respect to Russia, Ukraine, the Ukraine mineral deal that has been worked out with the United States. We saw shades of it coming up in the statements that you alluded to, the US president mentioning about his brokering a deal, India contradicting, he continuing to insist that he played a role in that. And yes, I agree with you. I think the fact that he would claim credit for having brought this current crisis to a datat, that's something on which there will be some conversation, certainly, in the forthcoming trade talks that are coming up. And I think India is also beginning to feel a bit agitated by this posture, because this is for the first time since the announcement of the tariffs that we did see on this round, India thinking of taking the US steel and aluminium tariffs to the WTO for a possible retaliation. So I think trade is really getting messy now.
No, absolutely. And on that, Mr. Palit, I'm glad you brought that point up, and it came through immediately when all these statements were coming in. So there seems to be a fundamental disconnect. The US president saying, you stop the ceasefire and I'll do more trade with you. But I don't think that posture is flying at all with the Indian side. There's been no acknowledgement actually of any of that in all of the Indian government statements. So do you think India will even be open to talking trade in exchange for, it's trade and terror? They're two very different things.
Subi, I take your point, but I'm just wondering about the room that you have in this regard for flexibility and maneuvering. Because if this point continues to come out of the United States that, look, guys, you better get into a good deal with us. Otherwise, we don't think that we will be able to play the role that you expect from us when future conflicts happen, and don't expect us to play a positive role in settling those issues. And there are countries across the world who have accepted what we are giving them. Why are you not accepting to those? I think this puts a country like India in a rather awkward position, because on one hand, it does have a very solid and stable relationship with the United States on a number of areas, not just strategic areas, but economic areas. But on the other hand, it lives in a neighborhood which is getting hostile by the day. And the enmities are increasing. There are no signs of peaceful resolution around India. And nothing in the foreseeable future. It does put India in an awkward position. And I think there is a further complication that comes in here. The US would have obviously noted the fact that India is engaged in simultaneous FTA negotiations. It's concluded one with UK, which has been a fairly progressive FTA by Indian standards. The mother of all FTAs is expected to come with the European Union. And there are issues which the US would want to be given to them, conceded to them, included in those FTAs and in addition to those FTAs. Now, it is this additional areas, say, for example, opening up India's government procurement market, which was listed as a factor by the US the day before the reciprocal tariffs were announced in the Foreign Trade Barriers report that it brought out. Now, these are issues where it is not easy for India to immediately agree, and particularly when you have the threat of a conflict management role being offered to you, as some form of a carrot. It doesn't work that way.
Yeah, no, absolutely. Mr. Palit, good morning. So one is, of course, posturing. The other is seeing what the US is actually doing, right? I mean, if you are any of the trading partners who Trump has threatened with very high tariffs, he has imposed very high tariffs, and then you look at how quickly they've folded with China, you actually would feel, I mean, you'd feel better, I mean, of holding out. I mean, it's actually, I can't see any, there are 4 or 5 things which they wanted to achieve with these tariffs. The way they folded with China without China giving in too much, none of those objectives have been achieved. So they've folded in that sense, at least in round 1, and there'll be more negotiations. So actually, isn't that an indication of, I'm not saying we get the same deal, but my point is they're willing to do this. They're willing to come down very fast without very much in return.
I think the game is slowly getting exposed. If you look at the US-China deal or the issue on which the agreement was done, 80% of it was a discussion on fentanyls. It has nothing to do with anything else, any other consideration, any other trade fact, any other trade issues. If you look across the world, the kind of reactions that the US is generating through its trade policy is completely ad hoc and totally unconnected. Now, the point over here is that this is something which is becoming so obvious that sooner or later, all countries, I mean, there are countries who will have a bigger capacity to resist this ad hocism on part of the US. There are countries which will not. For example, a country like Vietnam, given its dependence on the US market, given the fact that it's sandwiched between US and China in a regional supremacy battle, it will not have that room for maneuver. But I was just listening to the earlier section that you just concluded, the executive order on local manufacturing. This is nothing new. This is what the CHIPS Act was all about. This is what the IRA Act of the President Biden was all about. There's only one difference. The difference is that this time it is being told that foreign companies will be scrutinized that much harder. Well, they were always being scrutinized. It's not that the foreign companies would have been coming in with their own agenda and then getting away with this. If you look at the fallacy involved here, just what's been going on with ByteDance and TikTok.
Yeah.
Disinvestment till now.
Yeah, no, absolutely. Mr. Pal, my short point was that other trading partners will feel emboldened. That's all. Maybe they won't hold out, and not everybody's got the same size and muscle that China has, and countries like Vietnam, of course, much more dependent. But everyone is watching this closely in terms of how this has gone on. So that's my short point. I think that's fair.
I would say I definitely partly agree to it, but I would definitely also caution over the fact that the US is going to use national security and its ability to provide security guarantee as a very important tool in all the negotiations that it is going to do, and not all countries will be able to resist that. Some will not be able to do by that extent. So I definitely partly agree with you, but not wholly.
All right. No, point taken. Is a nuanced subject, and we have to look at that in that way. Thank you very much, Mr. Palit, for joining us and running us through your perspective. It's a pleasure having you with us here. What we'll do is just take a quick look at what markets are doing, and I think we have a quick view on the price action as well. Sachidanand is back with us with what he'd like you to do. I think markets have come off quite a bit from the day's high. I saw the Nifty Bank, which is maybe even slightly flattish to slightly lower. And of course, the Nifty is still up, but off the highs. Sajanand, what would you do?
Good morning, Prashant. Prashant, clearly, I think the market, momentum strength is something which is significant, and especially if you look at the way Nifty IT is contributing, the expectation is that we may see a swing towards 24,900. These are the levels that we discussed in the morning as well. So I think it's better to stay, on the long side. The immediate support on an intraday basis is placed somewhere close to around 24,655. We don't see that this particular support getting violated. So probably, one can keep a stop loss at 24,630 and keep adding long positions here. We are expecting that, Nifty IT can also start contributing from here, and which may help the Nifty eventually scale towards 24,900.
Okay. All right. And stocks, Sachidanand, any specific fresh calls?
So TCS is one particular counter that is looking, lucrative right now. The reward is looking better. We have a breakout from a falling wedge formation. The base at 3,500 looks very strong. From a momentum perspective, one can keep a stop loss at around 3,530 and add fresh long positions for a pattern target of around 3,630. The second stock on the bullish side is Poonawalla Fincorp. Now, if you look at the 60 minutes chart structure, it looks like an inverse head and shoulder formation with a neckline at 390. Now, this particular neckline has been breached, and the OI addition is also significant. So we may see this stock scaling towards 450, which is the pattern target. The stop loss for the trade can be placed at around 384.
All right, Sajanand, thank you very much for joining us. Good getting that sort of perspective on those trades specifically as well. Poonawalla Fincorp, inverse head and shoulder, breakout perhaps. The shipbuilders are the top two volume-led gainers. There's Garden Reach and there is Kochi, but there is Tata Steel also, which I think we will address in a bit. Tata Steel is the third largest volume-led gainer with a near 5% pop coming through at this stage. Okay, I think we have, we can cut across to the Chief Justice of India right now. Justice Sanjeev Khanna retired on Tuesday, marking the end of his tenure as the 51st Chief Justice of the Supreme Court. Justice Gavai was elevated to the Supreme Court on May 24th.
And it is Justice Gavai now taking over, taking his oath as the 52nd Chief Justice of India.
Okay, those are visuals coming in, and the oath-taking ceremony. The new Chief Justice taking oath, and of course, senior officials of the government present, and of course, the new Chief Justice being administered the oath by the President. We'll take a quick commercial break here. We'll come back. Markets up 150 points. Focus on stocks.
Welcome back. Well, let's focus on Tata Steel. I told you yesterday that, in fact, the numbers were actually good and the commentary as well was very, very good. But yesterday, the street ignored the commentary because, in fact, we did have markets that are a little bit brittle. But today, the stock is catching up. And as we normally say, disco is doing the disco today. Let's run you through a few points, though. The management spoke to us yesterday on pricing. They said that domestic prices have improved by around 3,000 rupees on a sequential basis. Even in Europe, pricing had improved out there. The second factor is the cost of coal. That is likely to fall by close to around $10 on a per ton basis, which is a positive. And finally, the EBITDA guidance that they gave us. Europe will turn into the black in the first quarter itself. And the UK, which has been a big drag, in the next couple of quarters, that as well turns profitable. So that's why, in fact, the street likes that. Nuvama, they are one of the brokerages that have gone ahead and upgraded the stock. The target price they've raised to around 177 rupees. They have raised their FY27 EBITDA estimate by around 6%. Because they're factoring in higher profits coming in from Europe and also lower fixed costs. They are estimating that the first quarter of this fiscal, that's quarter 1 FY26, the EBITDA number could go up by around 2,000 rupees on a sequential basis because of higher steel prices, lower coal cost, and also they're saying that there could be some softness in volume, but both these other two will offset that. Finally, the European operations, they say that it is likely to turn profitable in this year and it will start contributing meaningfully. So it explains why the stock is up and about. The other one we're looking at is Garden Reach. Ria joins us to help us out with a quick analysis on that one. Ria?
Well, yes, Garden Reach Shipbuilders is in focus once again today after reporting a healthy set of numbers in Q4 of FY25. The revenue has gone up by around 62% on a year-on-year basis. Even the EBITDA and net profit have jumped up by 144% and 119% respectively, both on a year-on-year basis. Margins have also seen an expansion of 454 basis points, coming in at 13.5% in this quarter versus just about 8.9% in Q4 of last year. For the full year FY25 as well, we've seen good growth on all fronts. The net profit margin has also been above the company's guidance of over 8%. The order book details haven't been disclosed yet, but in the Q3 earnings call, the company had said that the order book is expected to come down to rupees 22,000 odd crores by the end of FY25 as execution is picking up. And the order book at the end of Q3 was around rupees 23,877 crores. Some key things to watch out for going ahead will be the management's comments on the order book and the execution, and also the update on the delivery of one of the key projects of the company, which is the 8 ASW shallow water crafts, all of which are to be delivered by October of 2026. And remember, the first ship was delivered just last week to the Indian Navy. Commenting on the results, the management has said that with their strong order book and healthy order visibility going ahead, including in the commercial shipbuilding segment, they are confident of even better performance in the next financial year going ahead. Resultantly, the stock has been trading higher in today's session, up around 12 to 13%, but still important to note that it is down around 25% off its 52-week high at the moment. But largely, the results have been good for Garden Reach in this quarter, and the street is reacting positively to this.
Okay, big move as far as shipbuilders are concerned, and the defense theme very much well and alive. Let's focus on commodities now. Manisha is here with what she's got her mind on. Manisha, good morning.
Morning, Prashant. Thank you for that. I'm looking at the crude oil prices because we're trading at a one-month highs onto this one. The sentiment has been positive as the U.S. keeps talking about on how many countries they are talking to and the trade agreements are processing. Well, we also have seen the U.S. and China temporary relief for 90 days also improve the sentiment into the markets. That has been keeping the crude oil prices on the higher side. Apart from that, it also has to do with the U.S. producers. Remember, the U.S. has been talking about producing a lot, but that really hasn't been the case. If you look at the rig count in U.S., that has continued to decline. And the latest names that are coming in U.S. is Diamond Energy and Coterra, reducing the drilling activity, supporting the crude oil prices, not just for Brent, but the US WTI as well. And then it has been about fresh sanction threats against Iran. And this is coming in after the fourth round of talks that we heard in Oman. U.S. also is talking about fresh sanctions on 20 individuals and companies who have been dealing in sense of trade with Iran. So that there you have that adds to premium to prices. And then it is also about decline being reported in U.S. inventories. The crude inventories have gained, but when it comes to gasoline and distillate inventories, in the last week, we've seen a decline coming in for both of them, more in case of distillates, and that in turn has been supportive as well. The U.S. president is in Riyadh, and we've heard statements coming in from there. One thing bearish and one thing bullish. The bearish has been that the U.S. would look to lift sanctions on Syria. But the other thing is that U.S. has been able to secure a big amount to the tune of around 600 billion coming in from Saudi Arabia in sense of investments within U.S. when it comes to energy as a sector. So that is something that the markets see as bullish. And then it also has been about improved outlook in the global trade flows. Saudi Arabia also in the meanwhile seem to be pushing OPEC and allies to ensure that they do not produce more than or less than quota. So this deal is something that Street will watch out for. But there's a lot of uncertainty as well, because when it comes to crude oil, we do not know on what kind of sanctions or ease of business will Russia and Venezuela see coming in from US, and that will keep the markets in good favor as well. But when it comes to prices, well, the last couple of years were negative, and 2025 seems to be going that way as well. So even as we've seen the last couple of weeks see gains in case of crude oil prices, there you have it. 2025 is still down by 11% in case of crude oil prices. This comes in after 3% of decline last year and 10% of cut in 2023 as well. So it doesn't look very bullish coming in for crude oil prices. But if we are still in the first half of this year, markets will want to wait out for China demand and, of course, the trade numbers coming in.
All right, Manisha, thank you very much for that. 9% in the last 4 sessions on oil. Well, even as the situation along the border with Pakistan remains calm, US President Donald Trump again took credit for the cessation of hostilities between India and Pakistan on his Saudi visit. Meanwhile, US Department of State Principal Deputy Spokesperson Tommy Pigott emphasized the importance of direct communication between both countries. Listen in.
India has refused any US effort to mediate between India and Pakistan. How hopeful you are that you will be able to bring them together in the same room for talks?
Well, I'm not going to speculate on that. What I can say is that we encourage direct communication. We have been clear on that. We continue to encourage that direct communication. The president has been clear on that. And the president, as I said, has also been clear in praising both prime ministers for choosing the path towards peace and the wisdom and fortitude that shows.
Has US sent a team to Islamabad or Pakistan following the reports that there have been leaks of nuclear radiation in some of the secure Pakistani sites?
I have nothing to preview on that at this time.
Okay, well, we'll take a quick commercial break here. And on the other side, it's our special segment, is the economy. Lata in conversation with Neeraj Gambhir of Axis Bank and Abhishek Upadhyay of ICICI Securities Primary Dealership. Stay tuned, coming up.